The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you. You're listening to the Telltale's Weekend Update. I'm Ava Cabot.
And I'm Marcus Graham, the cash flow desk.
Quick note before we start, the show is produced entirely with AI tools, and both voices you're hearing are AI generated. Send feedback through the Substack. Here's the whole week in one sentence. The public market spent 5 days pricing its own cash machines for the graveyard. Single-digit multiples, double-digit yields, telecom and payments left for dead. And the buyers spent the exact same 5 days writing billion-dollar checks for those companies. Both of those things happened. They can't both be right. On Wednesday's show, episode 2629, Hunt, Jason, and Mike went value hunting and found it hiding in plain sight on page 1, in the hyperscalers everyone already owns. This weekend, we go to the other end of the memo, to the names the market gave up on and the people who just tried to buy them. Start with the group nobody wants to own. On page 6 of the cash flow memo this week, the entire telecom block, AT&T, Verizon, T-Mobile, Charter, Comcast. And the squeeze on that page is running in two directions at once. From the outside, it's satellites. Bernstein cut Comcast's price target to $28 this week, naming SpaceX's Starlink as a real threat to the cable broadband business, which is the tell, because in the same breath, Comcast was quietly still building, wiring up another 1,500 homes in rural Florida, most of them never served before. Marcus, the market's already pricing these like they're melting. Is it right?
On the cheap ones, I read it as a bet, not a mistake. Comcast's at 6.5 times free cash flow, a 15% yield. That's a decline multiple, not a value multiple. So the page comes down to one question. Is the decline terminal or just slow? If the broadband base erodes only 2 or 3 points a year, that yield more than covers you. If Starlink takes real share, it doesn't. The memo can't settle it. The prints start this week, and they'll tell us more than the multiple does.
And the money is not sitting still while it waits. Verizon spent the week shrinking on purpose, selling 274 company-owned stores to 6 operators and cutting 500 corporate jobs, taking its store count down to 1,000 next month. Marcus, Verizon carries the fattest dividend on the page and the heaviest balance sheet behind it.
Verizon's the balance sheet name. 13 times free cash flow, a 7% yield, but 7 times debt to free cash flow, near the top of the memo on leverage. At that payout and that debt load, selling stores and cutting jobs is just how they keep the dividend covered, while the top line barely moves. It's defense, not investment. I'd hold that read until the print Friday.
And then there's the one going the other way entirely. T-Mobile didn't shrink the business, it squeezed the customer. This week, it force migrated roughly 8 million people off their old plans onto pricier ones, broke a pile of free line promotions doing it, and now has until the end of the month to answer the FCC on price lock complaints. Marcus, T-Mobile's the odd one out on this page.
T-Mobile's the odd one, and it's priced that way. 16 times free cash flow, more than double the cable names, and unlike them, its free cash flow is still growing. It bought back $12 billion of its own stock last year, so the page sorts cleanly. Comcast and Verizon are cheap because nobody believes the growth, and T-Mobile's expensive because people do. That 8 million customer migration is what funding the growth looks like from the inside, and whether it holds is a regulatory question now, with the FCC answer due this month.
One sector, both ends of the squeeze, and every name on that page reports inside the next week, so we will know a lot more by Friday. Which brings us to the collision at the center of the whole week. PayPal is the cheapest cash machine in the entire memo, and this week somebody tried to buy it, and the board said the price was too low. Wednesday, Stripe and the private equity firm Advent put a joint offer on the table, $53 billion, $60.50 a share, a 28% premium. The stock jumped 16% on the news, and then, 2 days later, today, PayPal's board came back and called the offer inadequate, said it undervalues the company, citing execution and regulatory risk, a 28% premium, and the answer was no. Marcus, is the board delusional, or is it doing the math the market won't?
It's doing the math the market won't. Going into this, the memo had PayPal at about 6 times free cash flow, a 16% yield, the price you pay for a business you think is dying, And PayPal isn't dying, it's just boring. And here's the part the market kept ignoring. Last year, PayPal bought back more of its own stock than it generated in free cash flow. Management's been telling you it's cheap with the checkbook for 2 years. This week, a buyer agreed. The board's read is just that the first bid came in low.
So the smart money buyer and the company both think it's underpriced. It was the public market that had it wrong the whole time.
That's the trade, and you can see why a private buyer wants it. PayPal carries almost no debt, under 2 times free cash flow. A clean balance sheet throwing off a 16% yield is easy to finance. A buyer like Advent borrows against that cash flow, covers the interest several times over, and fixes the growth story out of the public eye. Stripe and Advent already lined up roughly $50 billion in committed financing from JP Morgan and Morgan Stanley, so funding isn't the constraint here.
And you could see the plumbing for that trade getting built in real time this week, couldn't you?
You could. Same week as the bid, KKR started marketing bonds backed by PayPal's Buy Now, Pay Later loans in Germany, the first securitization of its kind in Europe. That's a second set of lenders deciding PayPal's receivables are money good. When the assets underneath a company finance that easily, the buyout math gets a lot less speculative. The debt to do the deal is already there to be borrowed.
The lenders showed up before the bidders did. Tells you something.
It tells you the cash is real and that the debate now is about price, not about whether the business is worth owning.
So where does this go from here?
I'd waited. A board calling a 28% premium inadequate is usually the opening move in a negotiation, not the end of one. So the base case, call it 60%, is a raised bid, something with a 7 in front of it. Maybe a quarter of the time it falls apart on financing or regulatory risk, and PayPal drifts back to its boring multiple. The rest is a real bidding war. If a bank or a card network decides it can't let Stripe own these rails, what I'd watch isn't the headline price, it's whether a second bidder shows up, because that's what would turn this from a negotiation into an auction.
An auction for the company Wall Street spent 2 years calling dead money. And they report earnings the 28th, right into the middle of all of it, which is the theme of the whole rest of the week because PayPal was not the only check written. A few big ones, and then the forward calendar to close. 1. The biggest check of the week wasn't in tech at all. NextEra and Dominion filed to merge, a $67 billion all-stock deal that would create the largest regulated electric utility in the country, around 10 million customer accounts across Florida, Virginia, and the Carolinas. To buy the regulator's blessing, they're dangling $2.25 billion in bill credits for customers in Virginia and the Carolinas, the toll you pay to combine two utilities this big. Here's the cash flow footnote, though. NextEra already carries about 16 times debt to free cash flow, one of the most levered names in the entire memo, and its answer to that was to go get bigger. Powering the AI build costs real money, and somebody has to borrow to do it. This one closes in 2027 if the regulators sign off. 2. The checkbooks were out in pharma too. Eli Lilly agreed to pay up to $3.8 billion for a company called Atai Beckley to get a phase 3 nasal spray for depression that hasn't responded to anything else, a psychedelic-derived drug bought as pipeline insurance. That's the pattern of the whole week. If you can't grow it, buy it. 3. Now the counter-programming, because while all that cheap cash flow changed hands, the market was busy paying any price for the winners. Apple, page 1 of the memo, reclaimed the title of world's most valuable company this week, $4.88 trillion, edging back past Nvidia. HSBC upgraded it to a buy the same day and pushed its price target from 260 up to 366 on the AI story. Apple trades around 35 times free cash flow. Nobody is calling that a value trap. 4. Also on page 1, Tesla. Best quarter in the company's history, 480,000 vehicles delivered in the second quarter, up 25%, and it reports Wednesday. Now hold that delivery number up against the memo. Tesla trades at nearly 200 times free cash flow, the single most expensive name in the whole universe. Same memo, same week, 200 times for Tesla, 6 times for PayPal. That spread, right there, is what this entire show is about. And 5, the forward calendar, because next week is a wall of earnings. Tuesday, Interactive Brokers. Wednesday is the big one. Alphabet, ServiceNow, and AT&T all report. Then the telecom block we opened with closes out the week. Comcast and T-Mobile on Thursday, Verizon and Charter on Friday. We'll have the prints for you next Saturday. That's the show. Here's the one sentence to take with you. This week, the public market priced its cash machines for the graveyard, and the private buyers showed up with checks. Telecom at 6 times, PayPal at 6 times, and a $53 billion bid the board still called too cheap. Somebody is wrong, and we find out who over the next few quarters. Wall Street's consensus on the old cash machines, telecom, payments, the unglamorous half of the memo, is that they're value traps, cheap for a reason, and the reason is they're dying. Then somebody put $53 billion on one of them. Turns out the trap has bidders. So keep one eye on the boring half of the memo this coming week. The telecom prints, the PayPal board, whoever's next with a checkbook. That's where the argument gets settled. Everything we covered comes straight out of the cash flow memo. Download it at telltales.us. Hunt, Jason, and Mike are back Wednesday on episode 2630. I'm Ava Cabot. Thanks for listening. The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security, nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the host nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, express or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The host and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.